In this example, if you see, we have discussed the expenditure approach, and we are trying to compute the GDP using the income approach. And as you can see, there are only two components of income which are present in this example. One is the wage income, which is $15,000 as wages to oranging employees and $10,000 as wages to the juicing employees. So 15 plus 10, 25,000 worth of wages. Now interest and rent information is not given. We assume them to be zero. Now let us compute the profit of Orange Ink and Geosync companies. For Orange Ink, the total revenue is, as it is given, the total revenue is $35,000, but it incurs also cost of $15,000 in terms of wages. So its total profit is 35 minus 15, which is $20,000. Now, what is the profit of GeoSync? It is having a total revenue of $40,000. And as you know, profit is nothing but total revenue minus total cost. So total revenue is $40,000 for GeoSync, and it's what are the costs? There are two cost component. One, it is incurring on purchase of materials, raw materials, and another is it is paying wages. So the wages which are given is around $10,000, and the raw materials are purchased worth $25,000. So the two added gives us again $35,000 worth of cost, and revenue being $40,000. The profit is 40 minus 35 is around $5,000. So the total profit of Orange Ink and GeoSync is how much? We had got here 35 minus 15, 20, and here we have got 40 minus 25 minus 10, 5. So we have how much? 20 plus 5, $25,000 worth of profits, and wages were $25,000. So profit and wages together again gives us $50,000 worth of GDP, and which we had already seen it from the expenditure side. Now we can also look at the GDP from the value added perspective in this example. Now, what is the value added? Value added is computed as the sell price of goods minus the input purchase price. Okay, so let us do that for Orange Ink. Orange Ink, the total sales are of how much? $35,000, and its cost is how much? How much cost is it is incurring? It is not incurring any cost because the cost of raw material for it is zero. It is not given, so we assume it to be zero. So $35,000 minus zero, it is $35,000 worth of value added by Orange Ink. And what is the GeoSync's value added? Its value of sales is 40,000, and what is the value of its purchase of raw materials? It is 40 minus 25,000, which is $15,000. So 35,000 plus $15,000 of value added again gives us $50,000 worth of value added by these two companies. So we have seen whether we look at it from the expenditure side or from the income side or from the value added perspective, we get the same number, $50,000, because we are measuring the same thing from three alternate perspectives. Okay, now you can see the details of this example in the slides. The slides would be with you. You can cross-check your understanding again, but please go through it and see why the numbers are being which numbers are being added up when we are measuring GDP by a particular method. And please remember not to confuse income with expenditure, and you cannot add wages along with expenditure incurred. You will be messing up the different approaches. So please ensure that when you are measuring GDP by a particular method, you are using all the components or the idea behind that particular approach, and you are not mixing ideas from different approaches to compute the GDP. Okay, one thing which I must tell, it's with regard to the government's involvement. We have computed our GDP without considering government. But if we consider government, how the analysis would change? Nothing much would change. Only what is affected in by when government imposes taxes is the profits of the companies that undergo a change. So we have seen in the example that government is levying tax of $5,000 on orange ink, and on and of $2,000 worth of taxes on the geosync company. So the total tax collected is around $7,000. Now what happens? This $7,000 worth of taxes, the total profit, when we computed the GDP by the income method, the profits will decline by $7,000. But again, this $7,000 becomes the income of the government. So when we add the income of the government, we will find that the GDP again comes to the same $50,000. The point of essence is that the inclusion of government takes away a part of the profit, but which gets translated in the form of income of the government. So if we add income from all sources, again it becomes $50,000. As you saw, that was a fairly detailed example of showing the equivalence between the three approaches to GDP: the income approach, the expenditure approach, and the value-added approach. I will be discussing with you some more examples in the classroom, but that in a way concludes our first round of discussion on GDP as to the equivalence of the three approaches to look at the GDP. As we just discussed, GDP can be measured in three ways: income method, expenditure method, and the value added method. The approach that will be focused on in this course is the expenditure approach, and we would spend some more time on understanding the different components of expenditure which is considered while measuring the GDP. Let us look at from an analytical perspective what are the major components of GDP. Broadly, there are four components that we would talk of. One is one is the consumption, the second is investment, third is government spending, and fourth is net exports. And these four components gives us the national income identity, which is y is equal to c plus i plus g plus nx. In fact, this double equality sign I should add another bar so that it's y this is an identity. Y is equal to c plus i plus g plus nx. And as you know, the distinction between an equation and an identity holds good for all values of these variables. So irrespective of the level, y will be equal to c plus i plus g plus nx. Now let us look at a bit more detail into the various what do we mean by or what all things are covered under c, i, g and nx. Let us look at consumption. Now, what are consumption expenses? Consumption expenses are the kind of expenses that we incur on a day-to-day basis. If you see this slide, it is the total spending by the households on goods and services. And please remember one thing, one caveat with regard to the housing expenses related to housing. In fact, when we are staying in a rented house, we take the rental payment as a part of consumption expenditure. But homeowners who stay in their own houses, how do we treat the rental value for them? We know that you don't pay rent to yourself, but for the purpose of GDP computation, for homeowners, consumption will include the imputed rental value of houses. Computation purpose, it will be presumed that as if you are paying a rent to yourself. Now, if you see, as far as consumption expenditure, I have a few more observations. First, households spend on goods and services. Now, we have considered government spending as a separate category of spending. Now, government spending can be broadly divided into spending on consumption goods as well as spending on investment goods. Now, what is investment? We have already discussed. So one categorization is I take only the consumption spending by the households and consider the government spending on consumption goods and investment goods as one category as G, or else I can segregate the G into government spending on consumption goods and government spending on investment goods. Okay, and in fact consumption is accounts for the largest portion of the GDP. We would see how much how what is its share in GDP in just a few minutes, but let us now look at the investment. We know what it is. It is the change in the capital stock, and it is the total spending on goods that will be used in the future to produce more goods. What kind of spending will be considered as investment spending? Now, investment spending will include spending on machines, buildings, structures, inventories, and a host of things which helps the economy to produce more goods into the future. It certainly helps in the current period, but it also helps to augment your productive capacity for future, and that is why investment is so critical for an economy's growth. Now, in this context, it would be worthwhile to caution you about one aspect of investment as to what investment doesn't mean, or you can better appreciate if I say that the way we perceive investment is not the way investment is generally perceived in the common uses of the term. Now, generally people when they buy stocks or bonds, they generally say that they have made investments, but from a macroeconomic perspective, they are actually different forms of savings. Now, when you are buying a stock or a bond, you are transforming your savings into the form of stocks and bonds, because you have purchased those stocks and bonds from your by not consuming your entire income, but you are saving a part of your income to purchase assets. Then the question arises, then what do we mean by investment? Because if you see investment, the various what is categorized as investment, broadly investment would mean adding to the real stock of machines, buildings, factories, which helps the economy to produce more goods and services. Okay, please keep this distinction in mind. We have already seen this, the distinction between investment and capital, um, because investment is nothing but the change in the capital stock, and capital stock is nothing but the summation of capital goods at a particular point in time. Now, if suppose as on January 2007, 500 billion worth of capital stock was there in an economy, and during 2007 calendar year, investment of 60 billion dollars worth of investment worth 60 billion dollars were made. Then the capital stock as on January 1st 2008 would be 560 billion worth of capital. Now if I am interested to know how much is the investment made during 2007-8, it is nothing but the stock of capital at the end of the period, which is 560, minus the stock of capital at the beginning of the period, which is 500. So it is 560 minus 500, it is 60 billion worth of investment has been made. So either I take the initial capital stock, add the investment, get the capital stock at the end of the period, or I take the capital stock at two time periods and take the difference of the two and I get the investment. Now we have already discussed about stocks and flows in the context of investment. I think it will be useful to again reinforce the concept of stock and flow. As you know, a stock is a quantity measured at a point in time, like the capital stock as on a particular date. Now a flow is quantity measured per unit of time, and the investment, the change in capital stock, is nothing but the investment. Now if you recall, I had shared with you the example of fiscal deficit and the country's debt. Fiscal deficit, the change in debt during a particular period would be the new borrowings which have been made, which is nothing but my fiscal deficit. Or the existing stock of public debt, when you are adding the fresh borrowings, it gives us a new stock of public debt. Okay. And if you recall, I had shared with you the example of water flowing from a pipe to a bucket. Now the water which is flowing, the rate at which it is flowing is a flow, whereas the stock of water at a particular point in time is a stock. Let us look at some more examples of stocks and flows. Now a person's wealth is the stock, but then what will be the flow? Can you guess? Because the wealth is created from by creating new assets, and those assets are financed through the savings. So a person's annual saving is the flow, and when you are saving more, you are creating more wealth. And suppose I say the number of people with college degrees as on a particular date, this is a stock, but number of new college graduates this year, it's a flow. The government debt and the fiscal deficit or the budget deficit. Now you try whether these are stock or flow, the balance on your credit card statement, how much you study economics outside the class, the size of your compact disc collection, the inflation rate, the unemployment rate. We will discuss about them in the classroom, so I'm not spending time uh, on these exercises. Now let us look at the government purchases, because we talked about consumption, we talked about investment. Now we are talking about government spending. Now government spending is consisting of the spending at all levels, at the local, state and the central level. And please remember, G excludes transfer payments such as social security or unemployment insurance benefits. These are in the context of US. In the Indian context, it would be the the payment made by the government to the pensioners, and also any other kind of payment which is made, like scholarships and some welfare payments. Now these payments, why they are called transfer payments, and they are excluded from the computation of GDP, because we can look at it from two perspectives. One is when the pensioners get the pension and when they spend, that becomes a part of our consumption spending. So including it again in G will be leading to a double counting. That is one way to look at it. The other way to look at it is, GDP corresponds to productive activity taking place in an economy during a given time period. Now The payment which is made to pensioners, it is not for their contribution to production activity in the current time period, but as a recognition of their good work when they were in service at some point in time in the past. So because this payment is not corresponding to a productive activity at present or in the current time period, but corresponds to payment for being productive at some point in the past, we are excluding the payment to pensioners or transfer payments from G or from government spending. And also please remember that the transfer payments have a peculiar structure. Generally, any transaction which takes place in an economy, market transactions especially, involves a quid pro quo. Quid pro quo, in other words, means give and take. When you buy something, you pay for it. So there are two legs to a transaction. You are getting something and you are paying something in return. Now, as far as the transfer payments are concerned, they are unilateral payments. There is no quid pro quo associated with them. So the government is making a payment and it is not expecting anything in return, or it doesn't get anything in return. So because of this reason also, they are excluded from the computation of GDP. Now, as far as the last component is concerned, it is the net exports. Net exports are nothing but exports minus imports. Exports represent foreign spending on the domestic economy's goods and services, whereas imports are the portion of C, I, and G that are spent on goods and services produced abroad. And we also said that G can be conceptualized as consisting of a part of G is coming under C and a part is coming under I, because government can undertake consumption spending as well as government can undertake investment spending. What would be government's investment spending? Like building highways, building dams. All these things are a part of investment spending. But government spending on office stationaries, government purchasing fuel for its for its vehicles, these are all part of consumption expenditure. So if I take all these four components, I get y is equal to c plus I plus g, c plus I plus g plus nx. Now, if we see the share of different components in India's GDP in 2011-12 at 2004-5 base, consumption accounted for 59%, government spending accounted for 11%, investment accounted for 38%, and net exports minus 9% of the GDP. Now, if you see around a similar computation for US for 2005, we can always get the data for the latest years. You just have to go to the Bureau of Economic Analysis website of the US government. Now, how much it is? It is 70% consumption, investment 17%, government spending around 19%, and net exports around 6%. Okay. Now, see, the structure of GDP can convey many things about an economy. If you recall, from the previous slide, C was 59% for India. Consumption accounted for 59% of the GDP, whereas in US, consumption accounts for 70% of the economy. And that is the reason why sometimes US is called as a consumerism based economy. So consumption spending is driving the economy. Okay. And India investment share is around 38%. Now that is less than half for US. And and if we see government spending, in fact Indian government tends to underspend compared to US. um, we will we will see the implications of all these as we proceed in our study of different macroeconomic models. Let us see at the US GDP and its component for 2013. It was 68%. In fact, after the financial crisis, people have started saving a bit more, and that is reflected in a marginal drop in the consumption spending. If you see, uh, the net exports is which is now the center of attention in the economic debates in US. The US has entered into a trade war with Europe, China, and a host of other countries. And how things are going to pan out is anybody's guess. It is a center of attention. How the restrictive trade policies adopted by US is going to shape the growth prospects for um, for the emerging market economies, including India. We may discuss about the implications of it when I discuss with you the various models, such as the aggregate demand, aggregate supply model, when we discuss business cycles, or when we discuss about the external sector through the Mundell-Fleming model. But for the time being, let us concentrate on GDP. We can do some exercises on how GDP is impacted by different events. But let me leave it for the classroom. I will be solving with you a number of exercises with regard to different events impacting GDP. What we will do now instead is to discuss some of the measures related to GDP, such as GNP. Also, there is something known as the distinction between GDP measured at market price and at factor cost. We will see the distinction between them. Also, some new methodologies have come about in measuring GDP in India with a new base 2011-12. The implication of base also we will discuss. So let us discuss some measures related to GDP. As you can see on the screen, it is written the related measures of GDP. Let us take the first related measure, which is GNP. GDP stands for gross domestic product, whereas GNP stands for gross national product. Now, what is the essential difference between GDP and GNP? While GDP is having a territorial connotation, GNP is having more a citizenship dimension. In other words, GDP is measuring the output that is produced within the geographical boundaries of the country, irrespective of irrespective of from where the factors of productions are coming. Factors of production means essentially we are talking about whether foreign nationals are working in our companies, and also whether foreign capital is used in our production units. So it is irrespective of whether domestic factors of production or foreign factors of production, irrespective of the ownership issue, the total output that is produced within the geographical boundary is considered the GDP. But GNP is measuring what is earned by the factors of production of a country. Now, the factors of production can be employed outside the country also. So when we take into account the earnings of the factors of production, which are of the domestic country but engaged elsewhere, what is the earning they would be making? Once we add those earnings, we get the GNP. Now, GNP, uh, what it is measuring the total value of output produced and income received in a year by the nationals of a country, the citizenship dimension. But this is only referring to the wage component of it. But we know the other components of income, like interest, rent, and profit, they also have a bearing on the GNP. Now, so to take care of the different forms of income, we use the phrase net factor income from abroad. So when we add the GDP plus the net factor income from abroad, we get the GNP. Now this net factor income from abroad has got three components. What these are? They are the net compensation of employees, net income from property and entrepreneurship, and net retained earnings of resident companies abroad. Now, before we discuss each component, let me spend some time on the implication of GNP vis-a-vis GDP. Now, while GDP indicates the productive capacity of an economy, GNP is a crude indicator for the living standard. So, irrespective of from where money is coming, whether it is coming in the form of remittances, whether it is coming in the form of interest income or say dividend income from abroad, but nonetheless the money is available for spending in the domestic economy. And so the sum total of money that is available for spending, which is captured by GNP, uh, therefore is considered is a indicator of living standard. Now, if a country has more non-resident inflows to its GDP, its GNP will be higher than GDP. We are using the word net because to take care of the fact that not only the domestic factors of productions are working abroad, but the foreign factors of productions are also working in India. Like Indian nationals are working abroad, but so also foreign nationals are working in India. Indian capital is employed in say in US or UK, but similarly capital from US and UK is also employed in India and it is earning a return. So once we take care of what is the factor income earned by Indians as well as factor income earned by foreigners, then the difference of the two gives us the net picture. And for a closed economy, when there is no interaction with the rest of the world, there is no question of any factor income from abroad. So GDP is equivalent to GNP, and that is a scenario of autarky, a closed economy. Now GDP versus GNP. So what is the technical difference? GDP is measuring the market value of all final goods and services produced within a country in a given period of time. This we have already discussed. And now GNP is measuring the market value of all final goods and services produced by domestic factors of production in a given period of time. So why we say domestic factors of production? When Indian labor and capital are used abroad, they produce output and earn income, but this output and income are included in India's GNP but not in India's GDP because they do not represent production taking place inside India. As I said, it has got three components: net compensation of employees, net income from property and entrepreneurship, and net retained earnings of resident companies abroad. So let us look at each one of these. But before that, let me just give another example to drive home the point uh, that how GDP is different from GNP. Let us consider the value of a road built by an Indian construction company in Saudi Arabia. Now, what does the Indian construction company gets in return? It gets fees from the Saudi government. Now, that fees or that income of the Indian company is a part of the earnings of the domestic factors of production. So it is a part of India's net factor income from abroad. So when we add it to India's GDP, we get the India's GNP. Now that net factor income from or this net factor income from abroad is beyond the GDP, and because the production activity took place in Saudi Arabia, the construction activity. Now, therefore, it is not a part of India's GDP, but it will be counted as a part of Saudi Arabia's GDP. Now coming to the first component, the net compensation of employees. What does it tell? Net compensation of employees receivable from abroad is equal to the difference between compensation of employees received by the resident employees who are living or employed abroad temporarily and compensation of foreign nationals working temporarily in the domestic economy. Why we are using the word temporarily? It has an implication. Whom we categorize as temporarily staying in India, or for that matter in a particular country. Now somebody who stays for less than a year is considered to be staying temporarily, and technically somebody is designated as a resident of a country if that person's economic interest lies with the country in question. Now if you are a Indian resident, your economic interest must lie with India. Now to ascertain that your economic interest lies in India, the one benchmark that is used, that if you are staying for more than a year in India, then you are considered to be a resident of India. As you can see, the clause temporary resident applies to those employees who stay abroad for less than 1 year. Now, in case they stay for 1 year or more in a foreign country, they would be treated as normal residents of that country, and their income would be a part of the national income of the employer country. To make this point clear, let me give some additional examples. Say, a US citizen, if he is staying in India for say more than 1 year, now he will be treated as a resident of India rather than a resident of US for the purpose of computing GDP. Now, whatever he is earning, it will be a part of the national income of India. He will no more be treated as, or his earning will not be treated as part of the net factor income from abroad. Okay, because net factor income from abroad is applicable only for people who are staying abroad temporarily. Now, net compensation of employees, it can be a positive or a negative value depending on whether the Indian staying abroad earn more, or the foreigners staying in India are earning more. And as we have just discussed, you can get more information about who is a resident in this slide. Residents can include both individuals and as well as institutions. So we know that tourists and commercial travelers are treated as residents of their home countries. You can also get information about how the official diplomatic and consular representatives of a country are treated. The convention says that the official diplomatic and consular representatives of a given country, including the members of official missions and members of the armed forces stationed abroad, are considered extraterritorial by the country in which they are located and as residents of the given country. That means if there is a Indian Consulate General in Pakistan, the staff and the Consulate General, all of them will be treated as residents of India, and they will be considered as extraterritorial by the country in which they are located, in this case in Pakistan. So in a way, the Indian embassy in Pakistan is actually an Indian territory. Okay, and the people staying there, they are the residents of India. Likewise, if you see in Delhi, in Chanakyapuri, So many embassies are there, embassies of different countries like France, Italy, Germany, US. All those countries embassies are in Delhi. So those embassies and consulate general offices located in different parts of India, they will be treated as territories belonging to those countries to whom they represent, and the factor incomes generated by such residents are domestic products of the resident country. Okay, now it should be clear. And the factor income of locally recruited staff of foreign diplomatic military establishments are included in factor income from abroad. Okay, so now what does this mean? It means the last point. What does it mean? It means that the Indians who are working in the US embassy, they are being treated as if they are working in a foreign country, and their earnings are included in under factor income from abroad. Okay, now let us go to the second component, the net income from property and entrepreneurship from abroad. Now, what does this tell? This tells about the income received by way of interest, rent, dividend, and profit by the resident producers of a country, and the payments of similar type made to the rest of the world. As I discussed with you a few minutes back, if Indian capital is invested in US or in UK, the interest it earns, if capital is invested, the and profit is made from it, or somebody has purchased equities of a foreign company, and the dividend that one gets, all these will be treated as income from property and entrepreneurship from abroad. Now, not only Indian capital is invested abroad, which is giving us an interest or a profit, but foreign capital is also invested in India, and it is earning an interest and profit, giving rise to dividends. So the net of these two will give us the net income from property and entrepreneurship from abroad. In effect, what we are trying to measure is, there more resources available than what is produced in an economy, so as to enable a country's citizens to spend more. And that is why we say that if a lot of foreign capital is used in the domestic economy, which is leading to a lot of production, but also leads to a lot of repatriation of profit, then perhaps the living standard of the domestic economy need not be as high as conveyed by the GDP. By the similar token, if production activity may not be great, or GDP may not be very high, but if a lot of foreign earnings are coming to the domestic economy in the form of net factor income from abroad, the living standard of this country can be much higher than what is suggested by the GDP. And this component also includes the net interest received by the government on foreign loans. The third component is the net retained earnings of resident companies abroad. What does this mean? This corresponds to the undistributed dividends. Retained earnings refers to the undistributed profit of the companies. When companies make profit, they generally have to pay dividends. But when companies do not pay the dividend but retain it for future expansion, it is termed as the retained earnings. And generally, we come across instances of retained earnings when the company is planning future expansion. It requires more cash, so it doesn't dole out the dividends but keeps it for funding the future expansion activities without having much recourse to borrowings. Let us look at this component in some more detail. Now, what happens? The resident companies abroad are who? They are the companies belonging to one country and working in the domestic territory of some other country. And as we discussed, they sometimes they retain a part of their profits. Like the Tata Group, when they acquired Chorus in UK, Tata is a resident company functioning abroad. So why we say, because from India's perspective, the Tatas are incorporated in India, so they belong to India, but they are working within the domestic territory of UK. Now, if Tata's decide make some profit from their chorus operations, but they don't distribute it to the equity holders, but rather retain it for future expansion, so that will be treated as retained earnings of resident companies abroad from India's perspective. Likewise, foreign companies and their branches who are operating in India but incorporated in some foreign country, they may retain a part of their profits earned from India without distributing it. So what happens is the difference between the retained earnings of resident companies located abroad and the retained earnings of non-resident companies located within the domestic territory of the country will give us the net retained earnings of resident companies abroad. Why it is important, because and why we are capturing it in this way, the net retained earnings of resident companies abroad again is giving an indicator of the resources available with the companies within the domestic economy to carry out new projects and to reduce their dependence on borrowings. And it talks about the overall financial health of the domestic companies. Now, the net retained earnings of resident companies abroad, it can be positive or negative. If it is positive, it is contributing to the GNP. If it is negative, it's a drag on the GNP. Now, we can further elaborate the distinction between GDP and GNP, taking an example which we find in our day-to-day life. Let us consider the case of US Ford Motors in Chennai, how the GNP and GDP will be affected by this working of US Ford Motors in Chennai. Let us see. The income earned from the car factory would be counted as Indian GDP, because the production has taken place within India, and it is belonging to India's GDP but not belonging to the US GDP, though the company is incorporated in US. But now the company, because it is incorporated in US, it is entitled to repatriate profits to the head office of the company, which is in US. So the amount of profit the company sends to US will be a part of the net factor income from abroad, and in this case it will be a component of it will fall under the net income from property and entrepreneurship. The net factor income from abroad of US will be affected when the company sends profits back to US. Similarly, our GNP can be arrived by adding to our GDP the net factor income receipts, wages and profits from abroad for the factor inputs owned by Indians. So what in essence we are saying, the non-resident Indians income will be added to GDP to arrive at our GNP. But mind you, when we are talking about net compensation of employees, we are talking about people who are working temporarily abroad. Okay. Now let us look at some more concepts. Essentially, we will be distinguishing between what is known as market price and the factor cost concept of GDP. Now, the GDP that we talked about measuring through the expenditure approach was the market value of final goods and services uh, produced in an economy, or the total spending that takes place in an economy in the form of C, I, G, and NX. These are measured at what is known as the market prices, because the price at which goods and services are actually sold and purchased in the markets. If we see the three approaches to GDP, essentially what the consumers are paying, the same must be received by the various factors of production. And but does that happen in the real world? Uh, if uh, if we consider government's operations in an economy, sometimes we find there is a divergence between what the expenditure has been incurred and what is the income which has been earned in the production process. It will be more clear if I consider two aspects of government's operations. One is government is imposing taxes, and also government is doling out subsidies. Now, if I consider subsidies, what is happening? Uh, Suppose government tomorrow subsidizes, say, sugar. Now, sugar is available at 40 rupees per kilo, which is a subsidized price. Had it not been subsidized, the price should have been 50 rupees. So, government is giving a subsidy of 10 rupees to the producers. Okay. Why government is giving? Perhaps government is thinking that sugar is an essential commodity, and if it is at 50 rupees, many people would not be able to afford it. So why not make it available at a relatively cheaper price? Now, when 40 rupees is spent by a consumer, the various factors of production, they are not getting 40 rupees, they are actually getting 50 rupees, because 10 rupees is subsidized by government. So if I were to ask the question that what is that the factors of production are getting in the entire production process, then I should not be only considering what I should not be considering only the, the prices that is paid by consumers, but also I should take into account the subsidies, or I should add the subsidies which is paid by the government to the producers. Likewise, there is another operation of government which has a bearing on how much the factors of production earn. Let us take the example. Suppose when we buy any commodity, let us say a marker. When I am buying a marker, it is costing, say, 30 rupees. But does it mean that the entire 30 rupees that I am spending is going to all the factors of productions that were engaged in making this marker? Certainly not, because there are taxes also I am paying, because the marker is 30 rupees, the which involves a 20% tax. So in effect, I'm paying 25 rupees to the various factors of production which have gone into making this marker, and another 5 rupees I am giving to government as tax. So the 20% on 25 rupees. So the total price becomes 30 rupees. But in essence, the factors of production are getting only 25 rupees. So if I consider 30 rupees as the total payment to various factors of production, I will be overestimating the GDP. So I need to take out the indirect taxes from the from the GDP computed at market price. So when I make the two adjustments, when I add the subsidies and subtract the indirect taxes, I get what actually the factors of production are getting. We are talking about a net of indirect taxes and subsidies. So taking everything, all goods and services into account, how much of adjustment I need to make to my GDP at market price so as to get to the GDP at factor cost. Let us see. Um, the GDP at market price refers to the total final output of all final goods and services produced within the national frontiers of a country by its citizens and the foreign residents who reside within those frontiers that are sold at a market price in various markets. Don't get bogged down by such big sentences. They are written so as to embrace all aspects of a concept. As we are moving sequentially, you would appreciate the essence of what this long sentence tells. Uh, and we have already discussed subsidies are government expenses that are generally extended to business firms, farmers, among other groups to defray their production cost or to reduce the prices for consumers. And sometimes subsidies are also called negative taxes because they impose expenses on government's budget instead of contributing to revenues. And indirect taxes are government revenues that result from taxes that are not received directly from the earned incomes of households, but rather they are levied on the goods and services that people consume. So we are not talking about income tax. We are talking about income tax is a direct tax. So we are talking about indirect taxes. So some examples of indirect taxes would be sales tax, excise tax. Now, with the adoption of VAT, many of these things have gone. So, but the VAT, the value added tax, is again an indirect tax. So, um, please remember that. Now, if you see, um, the GNP at factor cost, or the GDP at factor cost, is nothing but the GDP at the market price plus subsidies minus indirect taxes, and same is applicable with GNP at factor cost. And of course, two more concepts. One is the gross national product we have discussed, which was GDP plus net factor income from abroad. Now, if I take out depreciation or capital consumption of fixed capital, I will get the net national product. Likewise, if I divide the net national product by the population, I will get the per capita net national product. Some additional points. Subsidies are paid by the government to the producer. Please keep it in mind. If the payment is made directly to the beneficiary from the government, it is known as a cash transfers, like the direct benefit transfers that is being talked about. If you see, GNP at factor cost was GNP at market prices plus subsidies minus indirect taxes. So we know that GNP at factor cost minus depreciation will be NNP at factor cost. And another way to put it is NNP at factor cost is nothing but NNP at market price plus subsidies minus indirect taxes. And you would have come across the term national income. And national income is not GDP. Please remember, national income is technically, national income is representing the NNP at factor cost, which is nothing but it refers to the payment to all factors of production consisting of wages, rent, interest, and profit. Ideally, the GDP by the expenditure approach and the income approach should give us the same number, but that doesn't happen in reality because of government intervenes in the markets. It imposes taxes and it also gives subsidies. So when we are looking at the expenditure, we have to make some adjustments to the total expenditure which is incurred to get to the income that is earned by the various factors of production, and the reason we have already discussed. You can just go through this slide for additional reinforcement. So in general, macroeconomic aggregates at market prices, whether GDP, GNP, NDP, NNP, per capita GDP, a host of variables, they, once we say market prices, they will include indirect taxes and exclude subsidies. And by the same token, when I'm measuring a particular macro aggregated factor cost, they will include subsidies and exclude indirect taxes. And national income is nothing but NNP at factor cost. Now, if you have understood the distinction between various concepts, you should be able to tell what these different arrows represent. If you see, there are three kinds of arrows. One is a dotted arrow, and this one is a broken arrow, and this is a solid arrow. Now, all the concepts that we have been discussing about, they are all put here and they are linked to each other by making certain adjustments. The different kinds of arrows represent the adjustments that need to be made to move from one concept of national income to another concept of national income. So we know this is the solid line. What does it tell? GNP at market price and NNP at market price. Where is the next solid line? GDP at market price, NDP at market price. And we have another solid line, GNP at factor cost, NNP at factor cost. So in all these three solid lines, we find the difference, everything else is remaining same except that the G becomes N. Market price, factor cost, these do not change. So what is happening? We are going from the gross, let us take one, the gross national product to the net national product, and we know the difference between gross and net is nothing but the depreciation. So this solid line must represent depreciation. Let us see. Okay, now if we come to the broken arrow, it is saying GNP at market price, GDP at market price. It is moving from gross national product to gross domestic product, from national to domestic, and we know from GDP to GNP we move by adding the component net factor income from abroad. So the adjustment here must be the net factor income from abroad, and the dotted line, what it says, from market price to factor cost. So market price to factor cost, we just discussed the adjustment that need to be made is indirect taxes and subsidies, which taken together we say as the net indirect taxes. So that is what do the arrows stand for, you can see here. If you see the last one that we discussed, the dotted arrows, it is the net indirect taxes. The broken arrow is the net income from abroad, and the solid arrow was depreciation. If you are able to see the connect between the various concepts of GDP, you can be rest assured that you have got the concepts. There is also the concept of personal income that we can discuss, which is we will see how the national income can lead to, or what adjustments need to be made to the national income so as to arrive at the personal income. Underlying the concept of personal income is the fact that it captures the income that is actually received by individuals, because why there can be a divergence between what accrues to individuals and what they actually receive, because of two reasons. One is individuals receive some form of income that they have not directly earned, like welfare payments, food stamps, also interest payments from governments and individuals. So these are the kinds of categories of income that they have not earned, but they nonetheless get these incomes. And likewise, individuals are attributed income, but they don't actually receive it, and you can relate it to the concept of undistributed corporate profits, which we had discussed under the broad rubric of retained earnings. So it's a kind of earning which is attributed to the individual, but the individual actually do not get it, or actually do not receive it, because of the company's policies, or sometimes the individual is making contribution to some of the government's sponsored social security schemes. So it differs from countries to countries. Now once we make these two adjustment, what we are doing, we are adding the transfer payments from government, but if we are taking out the income that is attributed but not actually received, we will get what is known as the personal income. And also there is a concept of personal disposable income, because when we talked about the factor cost concept of GDP, we we included indirect taxes, but we did not consider direct taxes. So when we take out from the personal income the income tax component, what we are left with is the disposable income. Now let us see how one moves from GDP to disposable income. What adjustments have to be made at each stage? Let us look at this. So if we have GDP, if we add the net foreign factor income, which is nothing but the net factor income from abroad, which we spent a good time discussing, we will get the gross national product, because GDP plus net factor income from abroad is the GNP. GNP less depreciation will give me the net the net national product. And the net national product, when I am adjusting it with indirect business taxes and subsidies, and also, and of course I am adding the statistical discrepancy here also, this will give me what the NNP at factor cost, which is nothing but my national income. Because if nothing is written, it is pertaining to at market price only: GDP at market price, GNP at market price, NNP at market price, and adjusted for net indirect taxes gives me NNP at factor cost. So NNP at factor cost is the national income, and from the national income, when I make adjustment for the income that you have received but you have not earned, and also income that is attributed to you but you don't actually get it, then you get what is known as the personal income. And personal income, when is adjusted for the income taxes, we get the personal disposable income. In our next discussion, we will focus on the changes that have been implemented in the accounting methodology of GDP computation in India, when the base year was changed from 2004-5 to 2011-12. I wish we could do a more detailed analysis, but whatever we have done, given the time constraint, I think that should suffice.